We've seen more than a week of turmoil on financial markets around the world after Donald Trump caused chaos by announcing tariffs, then pulling back on some of them, and then intensifying what now seems to be a trade war with China. But while Trump was able to stand a certain amount of fluctuation in the stock markets, many experts think he was spooked when bonds also began declining. And it's not the first time a leader's economic plans have been derailed by the bond market. Simon French joins me now, chief economist at investment bank Panmure Liberum. Simon, can you just explain to us, first of all, what the bond market is and how it differs from stock markets?
So the bond market is the market for capital that lends money at a fixed income rate to governments and companies around the world.
So basically, you are financing a government's ability to be able to borrow a government's debt.
Exactly. And they pay a given interest rate for that, but that debt trades after it's been issued, and the interest rate can go up and can go down. And what you've seen, and I think you rightly pointed in the introduction, is a very volatile economic and political backdrop has meant that investors are repricing how much they're prepared to pay to lend to all governments, but most particularly the US government. And because the US government has borrowed a cumulative $34 trillion from the bond market and really is the global reserve asset, the global safe asset, what happens in that market has massive ramifications around the world.
Normally, when we see market turmoil like this, what would we expect to happen in the bond market?
Well, so for UK viewers, actually, they'll bring back memories of 2022 and the aftermath of the mini budget, when the bond market, when it is not confident of the economic strategy being pursued by a pretty indebted government, and there are the parallels between Liz Truss and Donald Trump, they tend to say, right, actually, we will demand a higher interest rate for your debt, and particularly for long-dated debt, when, of course, the longer the duration, the more uncertainty about how profound those economic impacts might be. And what that does is it reduces the amount of leeway that a government has to pay its bills, to continue to do everything that it wants to do. And Donald Trump wants to do a lot of things, not least he wants to cut taxes in the US. And again, similar parallels with 2022 in the UK. And if the bond market says, no, we're not prepared to do that with a higher interest rate, it is the ultimate arbiter of how much political and economic power even a president has.
As you mentioned there, this is a safe bet often for investors, especially when you talk about US bonds. The fact that they are selling off, is that a sign that they no longer trust the US or trust them less than they once did?
Trust them less than they once did. There is a lot going on. It's not just the tariffs, although the tariffs probably was the catalyst here. There's a gentleman called Steve Mirren, who is the head of the Council of Economic Advisors for Donald Trump. Quite a relatively obscure economist, but he wrote a paper before Donald Trump's election, which suggested that if countries that were tariffed didn't come back with compromises and concessions, if they owned US government debt, they would be forced to substitute that debt for debt that doesn't pay an interest rate, doesn't pay a coupon. Now, that feels, and in the case of rating agencies who rate how good or bad anybody's debt is, that would look like a default. And for the world's biggest and most important debtor to be even talking, even negotiating around what might be a technical default, that is definitely what has spooked bond markets.
Do you think that trust will return, or has something happened here because of this turmoil, because of the uncertainty that cannot be undone?
No, I think it's far too early to draw that conclusion. This is one president who is in his second term, and the current makeup of the constitution suggests he can't have a third term. So the markets can, to some extent, look through that. Also, this is not a pain-free decision from investors to pull their money out of US government debt. I mean, for example, in the UK, half of pension savings are in either US equity or US debt. And therefore, if the value of that falls, that has profound impacts on our retirement incomes, all of us. And so the idea that that is going to happen wholesale, that pension funds, institutional investors, sovereign wealth funds, retail investors around the world are going to lose faith is almost certainly not going to happen wholesale. But even if it happens at the margin, that can be quite painful for investors with a shorter time horizon.
And Trump did mention this when he was talking about his decision to delay those other tariffs on countries that he said he had bigger tariffs on him, although those figures have been disputed. Do you think this was the thing that spooked him, that pulled him back?
Yes, I do. We won't know probably until memoirs start getting written, but I think enough people who are active in the industry, particularly in the hedge fund world, particularly on Wall Street, saw the type of pain that we saw again, parallels to 2022. Crystallizing where the Federal Reserve, the equivalent to the Bank of England in the US, was very, very close, we think, this week to bailing out a number of hedge funds who were coming under huge stresses. And at that point, what tends to happen is the head of the big investment banks on Wall Street, or indeed the head of the Federal Reserve, Jerome Powell, would have put a call into the White House and said, this will be the impact in pretty short order unless you change path. And I think that was what changed the president's calculations.
But just to go back to this point, because we did see the stock market tank. I mean, the Nasdaq, looking at that, is just an extraordinary line downwards. But that didn't seem to faze Trump in the same way as the bond market. Just go into that. Why is that such a key difference?
Yeah, well, the Nasdaq or the S&P 500 or the Dow Jones, that is effectively the price at which corporate America can raise money. So the higher their share prices, the cheaper it is for them to raise capital. That's why companies like high share prices. But the bond market really is the equivalent for governments. And so the pain in the stock market doesn't directly impact what Donald Trump wants to do in terms of tax cuts. The bond market absolutely does.
And then, as you've mentioned there, we obviously have seen this before with Liz Truss and her mini budget in 2022. Is there a sense that these radical economic ideas face economic reality when the bond market does start to fall?
I think the way to look at this is that you can change your economic policy on tax and on spending as you wish if you're not a huge borrower from financial markets. And I'll give you a parallel of Germany. So Germany in recent weeks, as a result of events in Ukraine and events with the United States, has torn up its fiscal rules that it's had for 15, 16 years. And the bond market barely blinked, because actually Germany is a very modestly indebted country, less than 55% of GDP, compared to the US at 120% of GDP and the UK at 100% of GDP. So if you borrow that amount from the bond market, when you change course, expect the bond market to want to have a say. Whereas if you haven't borrowed that scale, then you have far more latitude. So to some extent, what we're seeing is countries reaching towards the end of the road of how much they can throw back to the bond market, to lenders, to extend them lines of credit.
Well, you mentioned fiscal rules there in a country that borrows a lot of money. It reminds me of Rachel Reeves in the United Kingdom. When it comes to her fiscal rules, the bond market in the UK has obviously also been hit by this chaos over the past week or so. Does this mean that her fiscal rules are now more entrenched because she doesn't want to spook any investors?
So the durability of fiscal rules depends on events. We've had, I think, 13 versions of fiscal rules since 1997, so they're never forever. Events change them: pandemics, the global financial crisis, events surrounding the war in Ukraine. But When questioned in recent days, the Prime Minister and the Chancellor both said those are ironclad, non-negotiable fiscal rules. And by the way, that's exactly the right thing to be saying. No criticism from me on that, because you don't want to spook the market if you haven't got something else to say. But come October, November, whatever the budget is called, the geographical, the economic backdrop may be very, very different. So they're saying the right things now. It's not necessarily means that it will be the conclusion that they will draw in the autumn.
But will they be more concerned now about spooking the markets than they were before we saw those bond markets declining?
Yeah, definitely. What tends to happen is that when the bond market, as we also saw in mid-January, when those yields move higher, the pressure not to pour fuel on the fire and your ability to make spending commitments, or dare I say it, sort of commitments on tax cuts, or indeed anything that may say actually you are not being a very, very good custodian of the public finances, that just ramps up its importance, and it rather hems the current chancellor in, albeit not all of that has been her own making. It's been the making arguably over the last 15, 16 years since the global financial crisis, when debt as a proportion of the UK economy has largely been going in one direction, and that is up.
And just finally, we touched earlier on the loss of at least some trust in the US. Is there a chance, these tariffs have been postponed for 90 days, those 10% underlying tariffs are still in place? He has just imposed further tariffs on China. China has just come back with 125% tariffs on US goods. Is there a chance that US investors or worldwide investors start to turn away from the dollar, start to turn away from America because they just simply cannot trust the level of chaos that is happening in the country?
Yes, they will, and I think they are. Will that be wholesale? That's where I'm more skeptical. And what I mean by wholesale is the US is such a dominant player in debt markets and in equity markets. It's more than 50% of the global equity market. Will that either flatline, stop growing, or indeed decline a little bit because of those decisions? Yes. But are there other economies where investors want to pour their money into? Well, Europe, Japan, the UK, Switzerland, parts of Africa, South America, they're not necessarily either able or indeed attractive enough for investors to want to do that. So I would caution on the idea there'll be a huge U-turn, but I think the idea of actually strategically reallocating investor money towards those other geographies is probably what we're going to see for the remaining part of the Trump term.
Well, Simon French, an extraordinary few weeks, and I'm sure many more extraordinary weeks to come. Thank you so much for your time. Thank you.
My pleasure.